Greetings. Today we're going to be talking about fundamental analysis. Remember, this work is done by Twegbe Izuge. It is about forex, stocks, equity, bonds, and all chart-related trading. You're advised to subscribe, like, and share this class. So, like I said, we're going to be talking about fundamental analysis. So, the equity market is basically traded in two forms, either technically or fundamentally. Technically, we mean the use of charts, just as we can see, in predicting the direction of price movement in the market. So that is what we have always been doing. If you look at our previous lectures, we have always been talking about different patterns and movement in the market based on technical outlook. So fundamental analysis is another way of looking at the market. It is the use and study of economic, political, or environmental reports, as well as data and announcements, or any event to forecast the future price movement of currencies. So, fundamental analysis basically focuses on macroeconomic elements, such as economic growth, inflation, unemployment, and how they affect whatever we are trading. So, rumor as well as anticipation of any report coming out are all examples of fundamentals. It is important we know the numerical or economic indicators and also the market anticipation and prediction of that values. So fundamental analysis are very, very useful for long-term traders. But technical traders more or less focus on short term, but you're advised to focus on both. Whether you are a long-term trader or you are a short-term trader, both of them are very, very important. What do I mean by long-term? A monthly trader, for example, look at the monthly charts or the weekly charts. Are you getting it? While a short-term trader look at the 5 minutes, the 1 minute, the 30 minutes, or the 1 hour charts. So basically, short-term traders focuses on technical analysis more than on fundamental analysis, but both are very, very important. So let us look at some of the fundamental factors that can affect currencies. There are 1, interest rates, 2, monetary policy, 3, central bank personalities, or who is who of the central banks, 4, economic growth and outlook, 5, capital flow, and 6, trade flows and trade balances, 7, government presence and future, and 8, news and market data. So 1, for example, the interest rates. So the forex market or the equity market is ruled by interest rates. And the central bank interest rate decisions mostly influence price stability or inflation. So inflation is a steady increase in the prices of goods and services. Moderate inflation comes with economic growth, but too much of it can harm an economy. So this is why the central bank keep an eye on related economic indicators, such as the CPI and the PCE. This is to keep inflation at a comfortable level. So central bank will most likely increase interest rates, resulting in lower overall growth and slower inflation. So how does the government, or how does these government activities or central bank activities affect us as traders? So since interest rate dictates the flow of global capital in and out of a country. So investors will prefer to invest in an economy with a 1% interest rate than that of a 0.25% interest rate. So to traders, what is more important is where the interest rate is expected to go. Is it expected to go up or is it expected to go down? So a shift in expectation is a signal that a shift in speculation will start. And it will start to gain more momentum as the interest rate change nears. So basically what we are saying is that when the central bank wants to announce a new interest rate, for example, that expectation that the interest rate may increase or may reduce will start reflecting in the movement in the market to either determine whether the market will move up or whether the market will move down. Traders will start taking positions either to buy or to sell the currency, depending on what they feel or how they feel the interest rate will affect the market. Another fundamental aspect we're going to look at is monetary policy. So monetary policy boils down to promoting and maintaining price stability as well as economic growth. So the central bank uses monetary policy mainly to control or increase interest rates, which is tied to the cost of money. Also a rise in inflation, money supply, reserve requirement over banks, lending to commercial banks, and so on. So monetary policies are basically of two forms. You have the contractionary or restrictive monetary policy, as well as the expansionary monetary policy. By contractionary monetary policy, we mean the government or the central bank using monetary policies like money supply, rise in inflation, interest rates, and lending to commercial banks to reduce the size of the economy. So the government can also use this instrument to expand the size of the economy. That's why we call it expansionary or increase money, that's why we call it expansionary or restrictive or contractionary monetary policies. So to some degree, inflation is a good thing because inflation can grow the economy. But when out of control, inflation can remove the confidence people have in the economy as well as job because their money start losing value. So interest rate changes is what government encourage as gradually as possible. So say 0.25% to 0.50% to 0.75% to 1%. So government doesn't encourage shock, but what they want in the economy is stability, not shock. So the personality behind these announcements also matters. For example, the central bank governor and the minister of finances. So when they are about to announce a very important news, this can also affect the movement of currency or equities in the market. So their speech are either termed hawkish or dovish. They are termed hawkish when they are in support of raising interest rates to fight inflation, even to the detriment of economic growth and employment. And they are dovish when they favor economic growth and employment over tightening interest rates. So other fundamental factors are economic growth and outlook, capital flow, trade flow, and trade balance, as well as government whether current or future. So changes in government, for example, can either increase stability or instability in the economy. So instability in current government can have direct bearing on the country's economy and even neighboring nations. For example, the US is the world's biggest economy. If there is instability in US today, this will create a lot of fluctuations and equally affect the economy of other nations in the world. So another fundamental factors is news and market data. So news must move fundamentals as well as fundamentals also move currency pairs as well as the stock market. So successful traders were not born successful. They taught their way, they learn the trades, and they become successful at the end of the day. They go through forex news and market data, and you can get some of this news in pips.com, Reuters, babypips.com, freshpips.com, Bloomberg, MarketWatch, Forex Factories. For example, we can go to Forex Factory. Central Bank. We can go to Forex Factory and see what we have here. This forexfactory.com. So this is the display of the news today. So ensure that the news is a current news, and you must ensure that the site is dependable. You don't just go to any site and get forex news. They are reliable sites, just like the ones I've mentioned. CNN, BBC, CNBC, Forex Factory, MarketWatch.com, Bloomberg. These are reliable source of news, as well as Baby Pips, Reuters, Pips.com. So this is what fundamental analysis is all about. Like we said, it is the use of and study of economic, political, as well as environmental reports, data, and events to forecast the movement in the market. Just as may not be the only one making. So that is basically what technical analysis is all about. Thank you for being with us.